In 1972, Warren Buffett paid $25 million for a candy company in California. Wall Street thought he overpaid. That company, Candies, has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, and Buffett has called it one of the most important investments he ever made. Not because of the candy. Because of the moat. Welcome to the Daily Investor. Today, we are going deep on the single concept that separates great businesses from mediocre ones, the economic moat. Warren Buffett has talked about moats more than almost any other investing idea. In his 1999 Fortune interview, he said it plainly: the key to investing is determining the competitive advantage of any given company and, above all, the durability of that advantage. By the end of this video, you will understand exactly what a moat is, how to identify the 5 types, and how to use this concept to find businesses that compound your wealth for decades. This is educational content, not financial advice. Always do your own research. Think of a medieval castle. The castle itself is the business. The moat, that wide trench of water surrounding it, keeps invaders out. In business, the moat is whatever structural advantage prevents competitors from stealing your customers and destroying your profits. Buffett first used this metaphor in his 1991 Berkshire Hathaway annual report. He wrote about wanting businesses protected by unbreachable moats. Over the years, he refined the concept. In his 1995 shareholder letter, he described the ideal business as a castle protected by an ever-widening moat. Not just a moat that exists, one that grows over time. Here is why this matters to you as an investor. Companies without moats are in a constant fight for survival. They compete on price, their margins shrink, and eventually, they either adapt or die. Companies with wide moats can raise prices, maintain high profit margins, and grow steadily, decade after decade. The difference in long-term returns is staggering. Morningstar tracks a wide moat index, and from its inception in 2002 through 2024, wide moat stocks have outperformed the broader market consistently. Not all moats are created equal. There are 5 primary types, and once you learn to spot them, you will never look at a business the same way again. Type 1, Brand Power. This is when a company's name alone commands premium pricing. Coca-Cola is the textbook example. The company sells flavored sugar water, yet its brand is so powerful that consumers will pay 2 to 3 times more than a generic alternative. Buffett bought roughly $1 billion worth of Coca-Cola stock in 1988 and 1989. As of 2025, that position is worth over $25 billion, and it has paid billions more in dividends along the way. Coca-Cola sells products in more than 200 countries and territories. People do not ask for a cola. They ask for a Coke. That is brand moat. Type 2, Switching costs. This moat exists when it is so painful or expensive for customers to leave that they simply do not. Think about Apple. Once you own an iPhone, you have your photos in iCloud, your music in Apple Music, your apps purchased from the App Store, your Apple Watch synced to your phone. Switching to Android means losing or migrating all of that. Apple reported over 2 billion active devices worldwide as of early 2025. That installed base creates an ecosystem that locks customers in, not through force, but through convenience. Buffett recognized this. Berkshire Hathaway began buying Apple stock in early 2016 at around $26 per share, adjusted for the 4-for-1 stock split in August 2020. Apple became Berkshire's largest holding, worth over $170 billion at its peak in 2024 before Buffett trimmed the position significantly. Type 3, Network effects. A product becomes more valuable as more people use it. Visa and MasterCard are perfect examples. More cardholders means more merchants accept the cards. More merchants means more people want the cards. Visa processed over 212 billion transactions in fiscal year 2024. Every new user strengthens the network for everyone else, and it becomes nearly impossible for a new competitor to build that network from scratch. Type 4, Cost advantages. Some companies can produce goods or deliver services at a lower cost than anyone else. This is not about cutting corners. It is about structural advantages like scale, proprietary technology, or access to cheaper resources. Costco operates on razor-thin margins, around 2% net profit, but its massive scale and membership model allow it to undercut competitors consistently. Costco had 136.8 million cardholders at the end of fiscal year 2024 and a membership renewal rate above 90% worldwide. Type 5, Regulatory and Legal Moats. Sometimes the government itself creates the moat. Patents, licenses, and regulations can make it nearly impossible for competitors to enter a market. Pharmaceutical companies enjoy patent protection for roughly 20 years from filing. Utilities operate as regulated monopolies in their service areas. Railroad companies like Burlington Northern Santa Fe, which Berkshire Hathaway acquired in 2010 for about $44 billion, benefit from the fact that no one is going to build a competing railroad network across North America. The capital cost is simply too high, and the regulatory hurdles are too steep. 3 o'clock brand power, Coca-Cola. 4 o'clock switching costs, Apple. 5 o'clock network effects, Visa. 5:50 cost advantages, Costco. 6:30 regulatory moats, BNSF Railway. 7:15. Knowing the 5 types is only half the battle. You need to know how to verify that a moat actually exists and how to watch for signs that it is weakening. The first test is pricing power. Can the company raise prices without losing customers? Buffett has said this is the single most important test of a business. In his own words, if you have the power to raise prices without losing business to a competitor, you have a very good business. Candies raises its prices almost every year, and customers keep buying because the brand carries emotional value, people associate it with gifts and special occasions. When Buffett bought See's in 1972 for $25 million, it was earning about $4 million in pre-tax profit on $30 million in revenue. By 2007, it was earning $82 million in pre-tax profit. Same candy, same stores, just steady price increases that customers willingly paid. The second test is return on invested capital. Companies with moats consistently earn returns on capital well above their cost of capital. Look for businesses that generate 15% or higher returns on equity year after year. If a company earns high returns but has no moat, competition will eventually drive those returns down to average. The third test is market share stability. A company with a true moat does not lose market share in downturns. Coca-Cola, Visa, and Apple maintained or grew their market positions through the 2008 financial crisis and the 2020 COVID crash. But here is what many investors miss: moats can erode. Kodak once had an enormous brand moat in photography. At its peak in 1996, Kodak had a 70% market share in the US film market and was one of the 5 most valuable brands in the world. Then digital photography arrived, and Kodak's moat, built around chemical film processing and retail photo printing, became irrelevant almost overnight. The company filed for bankruptcy in January 2012. Newspapers had a similar experience. For decades, local newspapers had a near monopoly on classified advertising. Then Craigslist and eventually the internet destroyed that moat in less than a decade. Buffett, who owns significant newspaper investments through Berkshire, acknowledged this shift publicly. He sold off most of Berkshire's newspaper holdings to Lee Enterprises in 2020 for $140 million. The lesson is clear: always ask whether a moat is durable. Technology, regulation changes, and shifting consumer behavior can destroy what looked like an impregnable advantage. 7:30 The pricing power test, See's Candies. 8:15 Kodak, when moats collapse. 9:15. Before you invest in any company, run through this simple checklist. 1. Can the company raise prices without losing customers? 2. Has it maintained high returns on equity, above 15%, for at least 10 consecutive years? 3. Is its market share stable or growing? 4. Which of the 5 moat types does it have, and can you articulate it in one sentence? 5. What could destroy this moat in the next 10 years? If a company passes all 5 tests, you are looking at a business with a genuine competitive advantage. Now the only question is, what price are you paying for it? Because even the best moat in the world does not make a stock a good investment if you overpay. That is where margin of safety comes in, but that is a topic for another video. Here is the principle I want you to take away from today's video. An economic moat is not a luxury. It is a necessity. Without a moat, a company's profits will eventually be competed away to nothing. With a wide, durable moat, a company can compound your wealth for 10, 20, even 50 years. Buffett did not become one of the wealthiest people in history by finding cheap stocks. He did it by finding great businesses with wide moats and holding them for decades. As he has said, time is the friend of the wonderful business, the enemy of the mediocre. Focus on the moat first, the price second, and the short-term noise not at all. If this video helped you understand economic moats, hit that subscribe button because we put out a new investing lesson every single day. I want to hear from you in the comments. What company do you think has the widest moat right now? And if you missed yesterday's video on investor temperament, I would highly recommend watching it next. It pairs perfectly with what we covered today. I will see you in tomorrow's video.